Normally, if you do get a solicitor and an auditor in front of you, you should be really starting to sweat.
Yeah.
Because generally things have gone seriously wrong and it's going to cost you serious money. But in this case, don't be worried. That's not what we're here for. We're here to actually avoid that. We're here to actually go, well, what is being proactive as a director in your community and in your business and work through that. So we're quite excited by that. We are both quite passionate about this. As I said, the conference that we went to, we had a meal together and we started talking about governance and directorships and in our community. And so we're quite passionate about it based on the amount of years we've seen governance and good governance and bad governance. So why are we passionate about this? It's basically because we see that there's a personal liability that occurs with directors. The work health and safety legislation specifically ensures that directors are accountable and may be fined and may have to pay personal money, serious money out of their pocket if something happens. There's also obviously links to ATO debts, fines and litigations that does go directly to the top. It's just to try and force accountability in directors and probably scare them as well a little bit. There is the increased scrutiny that is happening across directors. You've seen things in the media. WiseTech in particular was an interesting case with the director, founding director. And unfortunately, in my profession, you've also got KPMG being bad directors as well. So it's a bit of a blight on my former employer from many, many years ago. So that's that. We also have, and you've obviously got increased undertakings there from ASIC of about 25% investigations on directors, and that's especially listed entities, and obviously civil proceedings there. There's also your responsibilities, and it's just if you don't have sufficient governance, you'll see a lot of those businesses lose their way. And unfortunately, also over my over 35 years of experience, many disappear. They just either merge or just close out, which is quite disappointing. And we also want our regions to thrive. We are very long-established businesses in this community, and we are very passionate about together we thrive. And that means in terms of employment, level of goods and services that are offered in regional Australia, as well as the attracting more people and intergenerational benefits. There's also particular rural and regional challenges with being a director. And that is that the talent pool isn't that large. We have some very great talents and people with experience across the region, but some of them are getting older, including myself, and there's an ability to actually find those new directors and new leaders of businesses to manage governance. You also have the challenges of accessing training and expertise and getting people within to come up to our communities to handle those particular things. There's also geographic distances. I know myself, I have to work within a 4-hour radius of Armidale as part of my business, and that has its own risk. It has its own challenges in governance. And Greg would be the same in terms of how much he has to travel. And all directors are aware some of those businesses have quite large footprints, and that has additional challenges to do with that. Then there's also the community expectations of directors. In metro areas, a lot of directors and managers can hide. Out here, you don't hide. Your reputation is quite important. You can't hide as an auditor, and it has good points. The community can rally around you when things are tough, but they can turn on you pretty damn quick as well, especially if you haven't got your governance structures right. And there's obviously a concentration of economics and industries in regional Australia. We have a very strong agro business, which has its good and bad points in terms of when it's good, it's good. When the drought happens, that can be a big challenge. As well as I just said, leading into climate and natural disaster. Businesses in this area see the full brunt of storms, hail damage, particularly in Armidale, or tornadoes, through to drought, which keeps being threatened to happen anytime soon. So that's really where it's very important to understand getting governance right. There's a lot of headwinds against us and things are stacked against us. So what we'll cover today, Greg will go through the director's duties and legal obligations that are there. He'll then pass back over to me and I'll talk about some of the corporate governance strategies and processes and frameworks that I have been exposed to over my career. We'll then go through some questions. Be kind to us. We may not be able to answer off their cuff, and then we'll go back to Greg to do some key takeaways. So over to you.
Thank you very much, and thank you, Paul, and to Kelly and Forsyth for hosting me and this event today. So as you actually settle into your chairs, I want you to think about an interesting fact. And that fact is that if you're a BHP director, the minimum salary you'd be on is $330,000. So that's the minimum. The duties that the BHP directors have are exactly the same duties that anyone here who is a director, a small company, a family company, a charity, a not-for-profit, and a corporate entity limited by guarantee, they're the same duties. So just think about that, because I'm sure not everyone here who is a director of those entities is getting paid director's fees of $330,000.
I'm going for photos.
We all should. What I wanted to talk about today is some cases, who the duty is owed as a director, who is actually a director and an officer, the legal framework around which these duties are formulated, looking at some core directors' duties, and then return to the cases. So I'd like you all now just to put your hats on, thinking that you're judges, because I'm going to give you some cases, some facts in cases, and I'd like you to think about the outcome that you as a judge would impose if you heard these fact scenarios. I'm not going to tell you what the outcome is until we get to the end of the presentation, and see if during the course of the presentation you change your view as to the outcome that you think should apply now. So firstly, Daniels and Anderson. That is a Court of Appeal decision from 1995. It was commonly known as the AWA case. Those of you who were directors in 1995 might remember that a fellow by the name of Andrew Covell was on the foreign exchange desk of AWA, and he went a bit rogue and entered into foreign exchange transactions to the tune of about 49 million, which were totally, as I said, rogue, and he caused AWA to lose that amount of money. Now, the auditors of AWA failed to pick up the fact that this activity from Mr. Covell was going on, and they failed to pick up the, and I'm sure Paul wouldn't do this, failed to point to the internal failings that were in the AWA system. AWA sued the auditors to try and get the $49 million back. The auditors, of course, cross-sued the directors and said, you're failed in your duty, and we didn't have a responsibility to tell you. What do you think the court said about that? The next case is a case Morley and Statewide Tobacco. That was a case where Mr. Morley had run a company, run a tobacco business down in Victoria. He'd run the business for about 20 years. His wife and his son became directors. Mr. Morley then died. The son took over and ran the business. Mum really didn't know much about the business at all. She was paid a living allowance of $300 a week, and that was about the total extent of things. Anyway, the son ran the business into the ground, didn't pay statewide tobacco. The company went into liquidation, and statewide tobacco sued. They sued Mrs. Morley, seeking $160,000 from Mrs. Morley. What do you think the outcome of that is? For Kelly, the next case, which is not down here, this is Deputy Commissioner of Taxation and Clark. Now, in that case, Mrs. Clark was a wife and mum. Her husband asked her, look, can you be a director of this great company that I want to start off, Southern Cross Interiors? The company went into liquidation. The ATO sought an indemnity from the directors to pay unpaid tax. At the first hearing before a Supreme Court judge, that judge said that Mrs. Clark had a justifiable reason why she didn't know that the company was insolvent when her husband was paying for goods that he knew he couldn't pay. And as the wife, Mrs. Clark said, I would usually, and this is a quote, I would usually have a frying pan in one hand and be signing with the other. She said she only became a director because her husband asked her and she wanted to be a good wife. The ATO appealed the decision of the judge in first instance because they wanted to recover from Mrs. Clark $200,000. The next case is Mills and Mills. This is an interesting one. I'm sure some of you here have heard of Uradree Station down in Hay. Those of you who remember pounds, shillings and pence, you remember the shilling and the little ram that was on the back of the shilling. That was the prize ram from Uradree Station. Anyway, Uradree Uradree Limited was run by Nielsen Mills and his nephew Ainsley. They were both directors and shareholders. Nielsen, being the older one, had more shares. The case made it clear that both of them hated each other's guts. They really couldn't stand one another. Nielsen controlled the company. He had more shares. There were significant unpaid dividends. And Nielsen, with his accountant, said, we've got to do something about this. And so what Nielsen did was that he, with another director, passed a resolution to capitalise the reserves and issue proportionately new shares to each of the shareholders. The net result was that Nielsen ended up with more shares and greater power. Ainsley sued and alleged the resolution was not passed for proper purpose. It was rather passed to give Nielsen more power. The HIH cases involving Rodney Adler were probably, at the time, Australia's worst and largest corporate collapse. In short, Rodney Adler was a director of HIH. An HIH subsidiary, on his direction, paid $10 million to a company called Pacific Eagle Equities, of which he controlled. Eagle Equities used part of that money to prop up the HIH shares, which were going down the gurgler. He used it to buy some tech shares unrelated to HIH, and used the money in other entities associated with him. The transaction really only benefited Adler and his entities rather than HIH. So that's HIH. Then ASIC and Beckier. Some of you might have read this about this case earlier in the year. This was the Star Casino case. Becky was the CEO and a managing director, or the managing director of Star Casinos. Paula Martin, who was also sued, was a company secretary and chief legal and risk officer. ASIC alleged breaches of director and officer duties against 11 directors and senior staff for running the junket known as Sun City for high rollers in Salon 95, which was a room located within the casino. And basically, ASIC alleged that there was money laundering going on. Executives received multiple warnings about money laundering concerns, but didn't inform the board. ASIC also alleged that Star allowed Chinese patrons to use a particular credit card, the China Union credit card, at front desks of hotels to draw funds disguised as general hotel expenses. So Georgie, my business partner, would be happy to know when I was in Sydney on Monday, I didn't draw any money out of the corporate credit card, but if you did, maybe it would be $100, $200. These guys were drawing out hundreds of millions of dollars using the China credit cards. Star's bankers, NAB, started to get a bit concerned. Star's bankers started to ask questions. What's going on here? The executives, not the directors, the executives gave incomplete, inaccurate and misleading responses to the information that NAB was asking. ASIC alleged that the directors failed to act on red flags. They allowed Star to breach anti-money laundering legislation, and they failed to keep the board informed as to what was going on. ASIC also alleged that the board members failed to exercise proper oversight, apply an independent mind to what was going on with management reports, and they failed to manage and guide the company's risk profile. So if you're involved in casinos, there's a real risk that there's going to be some money laundering. Just a couple of others that I'll go through. One is New Aim and Mr. Leung. New Aim is a major Australian importer of Chinese goods. They're an online retailer, and they invested heavily in finding out factories in China that were reliable, produced good products suitable for the Australian market. Mr. Leung was employed for about 10 years as the chief commercial officer of that company. While he was employed with New Aim, what he did was he had his mobile phone and he would put down the names in his mobile phone of these reputable manufacturers and his contacts. Once he left New Aim, he disclosed the details of a large number of those suppliers to a competitor. New Aim brought an action against Mr. Leung and that competitor, alleging there was a breach of confidence and a breach of statutory duty in that he misused corporate information. The primary judge dismissed the case. New Aim appealed. So it went back to a single judge. That single judge also dismissed the case and New Aim appealed. So by this stage, he'd had 8 judges involved. What do you think the final 3 judges said about that case? And finally, just with Dreamtime, Dreamtime was a case where a company called Steadfast alleged that several former employees and directors left the business and assisted a competing company, Dreamtime, by providing to them customer information, intelligence and pricing information with respect to security and other contracts for the lucrative Commonwealth government market. All of that occurred while the directors and senior employees of Steadfast were employees and directors of Steadfast. Steadfast alleged breaches of statutory duties, among other things. Think about those cases. We'll come back to them at the end. So really a threshold question for us today is, we're talking about directors' duties. To whom is a director's duty owed? Is it to a director of the fellow directors? Is it to a shareholder or shareholders? And the answer is that it's owed to the company as a whole. It's not owed to individuals. It's owed to the company as a whole. Who then is a director and an officer? And the Corporations Act defines who a director and an officer is. Those who are officially appointed, so if you did an ASIC search, you'd find out who the officer, who a director was. You can also be a director if there's a defective appointment. So let's say somebody has just forgotten to notify ASIC. And you can also be a director if you're a shadow director, somebody who exercises directorial control. So basically somebody who comes in and tells everyone what to do. They look like an actor. They walk like, they look like a director. They walk like a director. They are a director. An officer is anyone who can significantly affect a company's financial standing. So that can be directors, it can be executives, it can be company secretaries, it can be liquidators. There's a whole list of people who are the officers. Now, when we look at the legal framework around which directors' duties are formulated, there's essentially three key areas. There's the statutory duties, and that's through the Corporations Act in sections 180, 181, 182, 183. The insolvent trading provisions and section dealing with the duty of disclosure. There's state-based legislation, and incredibly, there's probably about 100 different sections within acts that impose liabilities on directors. There's common law and equity duties. That's judge-made law that's been developed over hundreds of years around what the common law thinks the duties of directors should be. Those of you who are in not-for-profits, the Australian Charities and Not-for-Profits Commission sets out various governance standards. For today, governance standard number 5 is crucial. It basically replicates the duties that are set out in the Corporations Act, which we'll look at further. And then, of course, there's the duties of directors that are set out in a company's constitution, in their rules, in their corporate governance documents. So what are the core duties of directors in terms of common law and equitable duties? Common law has always said that there is a duty of a director to exercise care, skill and diligence when they're performing their duties. Equitable and fiduciary duties, you can see they're maintaining confidence, retaining discretion, acting in good faith, acting for a proper purpose, avoiding conflicts of interest, and not making secret profits. I've set out here the core directors' duties that you'll find in 180, 181, 182 and 183. Section 184 sets out that if you breach those 4 duties, you can be held criminally liable. I'll talk about that a bit later. Section 191 imposes a duty on directors to disclose conflicts So a director must disclose a conflict if they believe that they have a conflict situation, and they should not be involved in any discussion or deliberation in relation to the issue with respect to that particular conflict. And I guess the duty that most people are very familiar with is the duty not to trade when you're insolvent. So let's start firstly with insolvent trading. And we'll take a deep dive into these core duties. The duty is actually triggered when the debt is incurred. So the company is insolvent or becomes so in circumstances where it can't pay its debts as and when they fall due. And what regulators look at is, were there reasonable grounds for suspecting that the company was insolvent at the time that the debt was incurred? And what the legislation says is that you as a director knew or should have known of the fact that the company couldn't pay its debts as and when they fell due. The consequences of trading while you're insolvent are personal liability for the company directors, civil liabilities by way of civil penalties, and criminal charges if you've been dishonest. And you'll see that I've raised some red flags there for rural small to medium enterprises. Because of the amount of insolvent trading that was happening, the government realised that, look, we want to give to directors a bit of an opportunity to try and work their way out of things. And so they enacted some amendments to the legislation, which have become known as safe harbour provisions. And those safe harbour provisions are very good if you're on the ball as a director. If you're not on the ball as a director, they're completely wasted, because the safe harbour provisions are very prescriptive. You must follow exactly what the legislation says you're required to do. So you've got to identify the fact that things aren't going as well as they could be going. You've got to be seeking advice from auditors. You've got to seek advice from accountants. You've got to seek advice from lawyers. You've got to find out what's going on. Why are we in this position that we're in? What can we do to get ourselves out of the position that we're in? Safe harbour provisions don't apply in circumstances where there's any employee entitlements that are owed, or you haven't complied with your taxation notice responsibilities. So safe harbour provisions are there to try and assist directors and help them trade out. And if you incur a debt while you're in a safe harbour arrangement, then you've got a defence to any claim or allegation that you've been engaged in insolvent trading. The next duty is duty of care and diligence. Directors are required to, when they're exercising their responsibilities as a director, they're required to exercise care and diligence. And it's an objective test. So when we're looking at whether or not someone has breached this particular duty, you're looking at what a reasonable person in the shoes of that director would have done or should have done. A defence to a breach of care and diligence or a failure to engage in care and diligence is the business judgment rule. And so that protects good faith, informed decisions where the director has no material personal interest and rationally believed that the decision that was made was in the best interest of the company. Section 181 looks at good faith and proper purpose. And so a director must engage in their duties as a director in good faith and for a proper purpose. And with this one, there's a two-pronged test. The first is that objective test. So what would the reasonable director in the shoes of the director have done? And then the subjective test for the good faith aspect is, did the director honestly believe that they were acting in the best interest of the company? When we look at section 192, we're talking here about a director has a duty not to misuse their position as a director. You can't use your position as a director for your advantage. You can't cause detriment to the company. And this is something you've got to be particularly careful about in regional settings, that anything that happens within a board setting is confidential. You can't go out and say, oh, look, I've heard this, or I've done this, or we're doing that, or we're engaging in a contractual arrangement with a particular person or a particular entity. You can't say, if you put in an expression of interest today, I think you might get the nod for the contract that I know our company is about to put out. And you could get in early, you could save us a lot of time. Can't do that. Misuse of information. So you can't misuse information that you have obtained in your position to gain an advantage for yourself. The critical thing about this is that it's not just directors and officers, but it is employees as well. So you can't cause detriment to the company. And this section 183 is used quite a bit in circumstances where senior employees leave the company and they take information with them. And so a company doesn't want that information to go to competitors. Section 191 imposes a very important obligation on directors that they need to disclose to their fellow directors any conflicts of interest that they may have. And that disclosure relates to material personal interests. And as I've said in the slide, it's all about transparency, making sure that everyone knows what the story is, disclosed it, okay, then the other directors can say, well, thanks very much, Paul, you've disclosed the fact that you're a member of Forsyth. You can't be involved in any decisions around whether or not we're retaining Forsyth as our auditors. Section 184 basically says if you are dishonest or reckless, you can face a criminal penalty, the maximum penalty of which is 15 years in jail. So it's a pretty serious offence to breach those duties that we've just talked about, recklessly or dishonestly. I needed to put this slide in because over the years, a lot of people have believed that there's this corporate veil that if you do something, if a company does something, you as a director are not able to be held liable for breaches by the company of legislation. What New South Wales has done is that they have said, or it has said, no corporate veils. What we're going to do is we're going to impose director liability on directors, and we're going to call it executive liability. We're going to call it special executive liability. In some acts, we're going to call it accessorial liability. positive officer duty. So for us here in regional New South Wales, the Biosecurity Act, the Water Act, countless acts have provisions talking about special executive liability. And if a director is aware of what the company's doing, and it's very hard to argue that a director of a small company, say a sole director, doesn't understand that the company is breaching the act or an act. So significant liabilities. Paul mentioned earlier the Work Health and Safety Act. That imposes incredible liability onto directors. And we're talking, in some cases, millions of dollars. You can actually be sued for industrial manslaughter if it's a really bad breach of duty. So that's what I wanted to say. It's a very quick overview. I wanted to go back to the cases. Daniels and Anderson, that was the AWA case. Any takers as to what the court found? I'll tell you. There was an objective standard. The court basically said, what would a reasonable director have done in the shoes of AWA directors? There's no such thing as a sleeping director. The directors were found to be negligent and found to have breached directors' duties by failing to supervise the company's financial management and internal controls. Basically, you can't rely on management. With Morley, Paul and Mrs. Morley, you cannot be a sleeping director again. You need to be involved in the company. If you're a director, you're a director. There's no escape. She was liable to pay $160,000 to Statewide Tobacco. Mrs. Clark, the same thing. The three judges, it was a unanimous decision, three judges in the Court of Appeal said, I'm sorry, whether you're a wife, whether you're a mum, it doesn't make any difference. You are a director. You needed to be involved in that company and understand exactly what was going on. The interesting case with Mills, that's with Nielsen and Ainsley, the court there said that even though Ainsley wasn't involved in the decision, the mere fact that a director derives a personal benefit or increases their voting control from a resolution does not render the resolution invalid. And provided the primary purpose of the resolution was honestly believed to be in the best interest of the company, then it's okay. And so that's what the court held, that it was in the best interest of the company. They had this £86,000 that needed to be converted. I think the case may have been decided a little differently if it was decided in the 21st century. Mr. Adler, obviously, he was a crook. He was disqualified for 20 years from managing companies. He had a civil penalty imposed on him of $900,000. He had a compensatory order imposed on him of $7.5 million, and he was sent to jail for 4.5 years. With Beckia, this is the Sun City case, and there was multiple judgments in this case. It was so huge, hundreds of pages dealing with the judgment. Essentially, the court held, and this is only a single judge, by the way, court held that Beckia, the CEO and managing director, had breached his duty of care and diligence. They found that the chief legal officer and risk officer, Paula Martin, had breached her duties, but the non-executive directors had not breached their duties. Beckia Becky received a $700,000 penalty and was disqualified for 6 years for managing corporations. The interesting thing about it is that I know that Becky is appealing that decision, so it may be that the Court of Appeal, when they see this decision, reverses what the judge said, but I don't think Becky is going to get away with breaching, with the breaches that he engaged in. With the New Aim and Leung case, that was a case that has gone backwards, forwards. Finally, the second Court of Appeal said, no, New Aim, you're right. Leung has done the wrong thing. They interpreted, and remember that Section 183 is all about using your position as a director and using or taking information from the company. Section 183, they said, is a very broad, should be interpreted in a very broad way, that information, any information of a company is protected by Section 183, and Mr. Leung's conduct departed from the expected commercial standards for a former CCO, and he made improper use of the information to gain an advantage for himself and his competitors. Finally, with Dreamtime and Steadfast, the story there was that the court found that the directors had breached Section 180, 181, 182 and 183. The crucial point about that case was that an employee may prepare to leave and may later compete with a former employer, but while they're still employed, they can't be offloading information to competitors. Dreamtime made about $1.6 million in profit out of the information that they got from the employees at Steadfast. And so one of the orders that the court made was an account of profits. And so Dreamtime had to repay $1.6 million back to Steadfast, being the profit that they made out of that information. Thank you, everyone. That was a very, very brief tour through director's duties. Pleasure handing over to Paul.
Thank you. Thank you, Greg. So we're going on to corporate governance, and it's really, in some ways, how do you manage all those sections of the Act and various other things in real life? We're attempting to do that. So this is very high level as well, and it's I've picked examples of these things, and there's maybe 100 examples that I've experienced in that time. So corporate governance it's a framework. It's basically a toolkit of how to manage things in terms of your relationships, your systems, your processes, and the authority to exercise and control the organisation as required under the Act. Essentially for directors, that is, what should you be doing, what should you be saying and advising in your role, what's your milestones in that case. We've split that into four strategic, four types of governance processes. If you Google, there could be 7, there could be there's multiple. We've just decided to go with 4. So with the strategic, it's strategic governance, compliance governance, operational governance, and risk management. You will see that as an overarching thing, but in some ways you could also call that as a separate exercise in itself. So strategic governance, that is really about where are you heading? What is the vision of the company? What is its long-term viability? What is its passion? What is it really trying to do and do well? And if you're using a movie analogy, we're in a director's chair, if you like to do that, it would be that, what is the movie we're trying to make? You know, how much are we going to spend? What is its genre? What's its target audience? Again, these could be simple things, but if you don't start documenting these things down, things just go off in never land because you're obviously not sticking to task. So I'll give an example of what, and unfortunately auditors tend to think of the bad experiences that have happened in corporate entities. We tend to work on the negatives rather than the positives. Business is enjoyable. It can be positive risks as well, but any business runs risk, and it's a matter of how you be aware of that and manage it. So we had a company with $2 million turnover, 7 employees, been around 75 years. It was delivering to 4 major corporations. It was quite a niche supplier of services, of which that board was made up of those 4 niche businesses. So it's quite closed, if you like, in terms of how it provided services. That's pretty straightforward purpose. However, a new CEO came on, and that CEO wanted to actually expand the services beyond that core thing and provide rapid expansion to others outside of those 4 entities. So a strategy was put forward to win the work. They need to upscale new buildings, new workshop, some new team members. They also needed some loan funding because it's a long-term asset to get that done. The business case was done. I have seen many things where business cases have never been done to say what is the, and it was approved by the board in their capacity as strategic managers. However, the problems then started from there. So first, the board took it at face value. They relied on management about their skills and expertise in terms of producing a board report. It was inadequately debated. They didn't really sort of go back to their visions, to their values, to their core principles to go, well, why are we expanding outside of our core 4 traditional areas we do with? Is that really a good thing? Do we understand what's going on? I've seen that many a time where a business will take on a new thing and they're not really sure or understanding what's there. And if that's the case, you need to have more homework done before you do that. Second, the board didn't scrutinise the business case. There was a lot of airy-fairy numbers and in the reality, some fictitious things that were in there that they didn't really question or push forward. And the board didn't do their duty of care in terms of their project management. They weren't actually looking at, well, this was the plan and how is it going? Where are we on track? What's happening in the background? In the end, what happened? Well, the revenue never showed up from the new build, the expansion. The costs flew out on the building. Surprise, surprise, that happens quite a lot. They had a brand new head office with significant debt to the contractor. However, they forgot to do their homework to make sure the funding from the bank was secured. The bank didn't give them the funding. They also were looking for some grants. That grants fell over. So they eventually ran out of money. And after 76 years, being 1 year on from the 75, they fell over. It's gone, disappeared. So that's very sad. Loss of employees, lots of services to the region. So how could that have been avoided? As I said on the slides there, it's going to be about understanding who you are as a company and then where you fit into that. It's your vision, your personal values, the corporate values that are there. Why are we doing this? Looking at the fine print within things, looking at the modelling and looking at asking for assumptions, asking the difficult questions of what could go wrong, or if this scenario doesn't happen, what's the backup? And then holding management to account in terms of, yes, this is a project. By X date, have you done this? Oh, have you gone and got the borrowing facility? Has it been signed off? So what good looks like is that clarity and building a strategy. Obviously, with some small entities, it's maybe only one piece of paper, but for others, it's going to be multiple pages, and it depends on the complexity of the business, the service lines, the locations, the type of people you're dealing with. And then that strategy just does not sit on the shelf. That is part of what you do day by day. It's in your agenda, it's in what you do. You live and breathe it, and you go, well, we need to tweak it. Too many times I've also seen we're sticking to the plan for 3 years. We're sticking to the 3 years. And the things have moved on in that time, and they really haven't been adapted to go, let's move on with that. Compliance. That's probably where we fit in a lot. We check to the rules. So compliance is what you can and cannot do in the pursuit of your trade. And what is legal, what is ethical? Because obviously sometimes it's the legal side, we put in that, but there's also that, what is your community's ethical position? What is your personal ethical position? And have you crossed the line there? And when you start doing that, it's a slippery slope into oblivion. So if you're running a film, as I said, doing the film, it's going to be, is there inappropriate themes within the film? Is it, what are the working conditions? Are you doing this film in Mexico or somewhere in the New Zealand? What are the laws? Is there a law about nudity in front of a temple or something like that? And maybe we should have not been, we thought about those things. Give a practical example of what has looked bad in that space. As mentioned about the tax office, and there was case laws about those. If you get in debt with a regulator or the tax man, it's a difficult road to be in. So if you forget to lodge your tax returns, do your BAS returns, get behind in paying your BAS, get behind in your super, then you'll end up with lots of fines. You end up with interest rates well above your commercial interest rates. You'll end up with quite challenging repayment terms, and you'll end up with higher scrutiny from those regulators, the taxman. And you really do not want the taxman crawling all over your books. The other part, unfortunately, is work health and safety. In that time, I've seen tragedy, and I've also seen near miss. I was a mine auditor, and unfortunately, mining is high risk. So a gas explosion in the Hunter Valley killed an employee. It's devastating in that regard. But the overall blowout of that was loss of half the mining licence, personal fines to directors and foreign owners, fines to managers, huge regulation, disruption of business, major financial losses. They didn't recover, but it was a significant hard road. The other thing is near misses. You might go, okay, nothing happened, but there is obligations for near misses to report that. So an example, a backhoe operator touched the power lines, no one died because luckily there's rubber on the tyres, and for their employees that didn't happen as well. But you've then got to report that, you've then got the regulator coming up, you've got delayed construction, you've got the client whinging and screaming that you haven't met things, you've lost faith with your employees, you've lost faith with your regulators, and again, it diverts your business and it creates costs and losses and angst. So what do you do in terms of doing better in that regard? So to me, the common area would be that legislative compliance. We tend to have the thing on top of mind or what's recent that has happened to you, and therefore you manage that. But it is an arduous process, and it probably could be a boring process, but reviewing that legislative compliance is quite critical, is understanding how many pieces of things you need to deal with. Is it 60? Is it 10? Is it 1,000? With councils, it's multiple thousands, it could be argued. And it's then ensuring, well, what do you need to monitor a lot of? What do you only just have to do less of? And then how you're going to be responsible for it. And again, continuing to look at those non-compliance reporting and coming back. And too often you find that when you look at that legislative compliance, what is the insurance cover? What do you have as a mitigating factor? For example, cybersecurity has become a more and more massive item, and there are so many corporations without cybersecurity insurance or very inadequate cyber insurance. And with the storms covers and various things that are happening as well, as I've said in regional Australia, shortfalls in that cover is occurring, and that means that you will end up paying out yourself. Move on to operational governance. That is your day-to-day. So that is business as usual. Just doing everything as you should. If you were doing in the film, it's about, is the hire there? What's the day schedule? You know, the toolbox meetings, you know, are we on track? Is the film on budget? All those particular things. In terms of an operation example of things going awry, fraud is popped up a few times in my experience with audit. We have to do the mop up and the investigations in that regard. A lot of fraud is trust, and unfortunately over trusting in employees and management, and maybe even over trusting your fellow directors. It's about the lack of controls, the lack of oversight, the lack of supervision duties. We had one fraud where the whistleblower came in and said that there was a purchase of an asset on the credit card that didn't look like something that the operations really needed. That was the tip of the iceberg. We came in, obviously that piece of equipment never existed within the company shed. I think it was actually being used at home. As part of that, then we found that about 6 months, there was about 20% of the expenditure didn't have documents, didn't have invoices, had some quite creative words written out within the purchasing. Gave themselves a pay rise as well as manager, and then went, okay, and I also have back pay as that. It so happened that 30,000 coordinated with a European trip at the same time, and it's quite convenient. They employed a marketing manager when that business really probably didn't need a marketing manager, and that marketing manager was also in a very, very, very close relationship with the manager. So happens a lot. So how did this happen? It was inappropriate oversight, you know, key accounting functions just ignored, incompatible duties in that the general manager could go and order goods and pay for goods and obviously keep goods. And that's a matter of making sure what is there. The board didn't ask the right questions. They had a pay rise proposal and that was shot down, but then they didn't follow it up and they weren't monitoring the pay expenses and why things were blowing out. The board was trying to stick their head in the sand as well, and they were a bit lethargic about dealing with the difficult questions. So they might have let one expense slide, or they might have heard something and went, oh, I don't know what to do with that. Obviously, it moved into back pay, it moved into various other things, and the culture was shot. Firm's culture was shot. And then the board didn't really know what to do. Should they put him on gardening leave? Should they sack him? Should they? What are they doing? And they sort of were in fright. And when you're in basically not doing anything, it just gets worse and worse. So what does good look like in terms of operation? From a board, it is some very structured board agendas. It's very structured schedules of when those board meetings occur, standard items, and then obviously if there's no response to those items, it's like why is that happening, or why has there been no new thing in that agenda item, should that agenda item exist. Delegated authority needs to be defined, and that delegated authority is not just who pays the bills, but it's about contract management, project management, media releases, anything you like where you need to be delegated and understand what's there. And your policy procedures in terms of your rule books. So in other words, what is your procurement? What is your capitalisation? What is your investment process? Too often I've seen good and bad investment strategies or no investment strategies. I've seen not-for-profits with maybe $1 million sitting in cheque accounts earning no interest. And it belies belief. And then therefore you go to them and go, I'm not a financial planner, I can't say anything about that in terms of product, but I can say, where's your investment strategy? Why is it all in cash? And I've seen positive stories that returns to $100,000 in money, soft money going to the charity to fund its operation. Clearly, there's also the bad, where investments have gone into things they should have never understood, and they lose their money. So that's why that's critical to have those things in place. And also setting up your assurance processes, your monitoring. So in other words, who should be doing checks? Sometimes they just rely on the auditor. No, the auditor is only focused on the financial statements and focused on materiality. There's also going to be work health and safety. We don't touch that. It's not part of what we do until the fines hit or where the problems hit. So it's going to be, who are your consultants? Who are your experts? Is the board doing their own self-assessment? Is the board walking the floor? I've seen good boards, they're actually out going to the sites and going, well, what's happening here? Risk management. This is a fundamental underarching thing, and I've talked about risk as my examples as well. It's a discipline in its own. And again, if you don't start thinking about risks and how you treat risks, even if it's a one-pager or in some pages, 20 pages, you're going to, again, it's front of mind risks or the latest new risk that's come out like cyber or something else, and you really then forget some of the fundamental risk of work health and safety. Again, people do put processes in place, and as human nature, they tend to forget it or it morphs into something else. And again, they haven't gone back to review that. So what can go wrong with risk management? I have an example of software implementation. In my 40 years in software implementation, I tend to break out in a sweat when anyone advises me they actually are going to change the software. I've seen a multinational company completely lose its way with inventory management and ended up spending £20 million in stock they were never able to get rid of because they just ploughed in. So it can happen to the big boys, and then obviously you can go through that from that. About half get it pretty well right. Well, a few things that aren't quite right, and then there's others that there's some things missing, unfortunately. So in this case, there was a software package well past its use by date. It's going to be turned off, so they had to be forced to do something. They pulled a project committee together. Tick, that's a good start. They've got some quotes from various software providers. Great start. And then it just went pear-shaped from there. There was no risk management at all, no understanding of do these guys know what they're doing, if people leave, who's the backup, etc. like that. And all those things just came home to roost. They did nothing in terms of risk or project management. So in the update, they made a call on the cheapest software. Of course, what could go wrong? You go to the cheapest software. And they spent whatever it is, $1 million. Unfortunately, it cost them $3 or $4 million to get it right afterwards. And they then had to abandon it anyway. It was useless. So consultants ended up making lots of money. The auditors had to do additional time as well. We made some money, but no one actually won out of that. And that they had to obviously abandon it and put new things in place. So it's a lot of that understanding the risk, monitoring the risk is important. So what is good risk management? Well, that is, it's going to be understanding your risk appetite. Because, and people, I see it, it's like there's quite a blanket risk appetite. We have zero tolerance to everything. Like, you're not in business with zero tolerance. In fact, if you're doing that, you just have a term deposit and go and sit on the beach somewhere. It's your business runs risk. But for work health and safety, it probably is zero. You don't really want to go there. The heartache, the concern over loss of life is dramatic. But things like what type of investment you might have $1 million. You might go, I'm happy to have a bit of a high risk element, a bit of a roll of the dice. I'm going to buy some WiseTech shares. And then the other ones, the rest is going to be in an ETF or some type of managed fund. It's that sort of risk understanding, and it's not fit for everything. And then it is doing those workshops. What are the risks out there? What is your legislation? What is your strategy? Where is it all fit? And what are the particular risks you need? And then what controls do you have in place already? Some controls mean you don't have to touch it. But for other things, there's big gaps and you need to work through it, including I don't have insurance for that. Maybe I need to fix that. Maybe I need to revisit my insurance cover and come back for that. And then regular reports on that risk. For some small business, you might think, oh, it's all in my head, but that's the critical thing. It's in your head and not written down or not shared with your business partner or with your wife or the family business. And it's needing to know all those things are written down. And it might sound simple, but things go awry if you don't start thinking about it. So I think that's that. So that's a lot to digest. It was quite heavy. A lot of tax legislation come out, and a lot of things from experience from that. It's a vast area, but doing nothing is not the right solution here. You need to be starting to document things, chunk it down and go, oh, I'm going to treat something this week and I'll treat something next week. And then, by the way, you eventually get there and working through that. So thanks for your time. I think we've gone well over, but we'll go through that and we'll take some questions.
Yeah. Any questions?
I spent the whole hour listening to you guys, and all I could think was, how can I get around this? Where's the loophole in this? And you didn't help me out much.
So I can answer that question. We're in the worst case scenario business. We deal with situations and circumstances where things have gone wrong. What we really like to do, though, is engage with people in a proactive way. So we do courses, we do come to boards, we do speak to people to put in place the governance framework that Paul's been talking about. We do talks to boards about their directors' duties, do help boards through with safe harbour. So yes, it's, you know, what we've been talking about is very negative, but you've got to realise that there's not that many Adlers around, there's not that many Covels around, there's not that, you know, the bad directors. Most companies, the vast majority of companies get by perfectly okay, no problems, no issues. It's just when people start taking their eye off the ball, when they start doing things that they haven't done before, when they rely on people that they really shouldn't be relying on. That's the key, being proactive, keeping your knowledge up, understanding what the risks are. And I think most people, if they engage in that sort of process, will end up with a successful company without having any need to call on Paul or people like myself.
Related to that, do you see AI in now, I guess, complacency that can come with clients?
I think you've got to be very careful with AI. If you generate anything with AI, you've always got to check it. AI at the moment has so many hallucinations. So you could put in, for example, you could put into AI, give me all the cases and directors' duties. And those, you wouldn't necessarily trust what you read. You've got to check and double check. And I think that's what will be happening with AI. AI to me is, it's going to, certainly in terms of my practice, we see that AI is fantastic because we're going to get more cases. Because I mean, just to give you an example, a person phoned up. They wanted a quote to do a particular agreement. We gave them the quote. They said, "Oh, that's too much. We'll do it ourselves." And literally the next week, they phoned us to say, "We've got a problem with the agreement that we signed with the person." And so they used AI. And I think AI is fantastic, don't get me wrong, absolutely brilliant, and helps with so many boring, repetitive tasks and can get you started. But you need to be focused and appreciative of the fact that it is artificial intelligence. It's not our own intelligence, and it's not putting our own experience and our own knowledge and our own skills into the work that has been produced.
Yeah. Well, I mean, you can't prevent it either. So just saying, oh, we're just not going to do it, is also can be anti-competitive to yourself. The things are going to move regardless. So for us and for companies, we've encouraged that they do AI policies. So they go, well, what will we use and what is safe to use? And do we buy something? You know, again, it's the buying the ones, not the free for all ones and the free, because the free you get the bigger problems. It's also setting up when you do get that supplier, are they ISO compliant? Do they have those tickets? Do they have those things about risk management that are there to give you assurance? And therefore, and then you set your rules to your employees or to the people using it to go, how are you to use it? And also then making sure that you are monitoring and put your own flavour and you put your own results in. Because there's nothing I've seen, and you'll see slop, you'll see IA slop come out of reports. I've got staff, it's a good starter. So I might give you that 60% of something and you go, okay, at least I don't have to do that. I can use my brain power, I can use my experience to add to that.
No. Go back, right back to your beginning, which was small community in a rural setting. And I hope I'm not the only one here, but many of us are here because we are volunteers and we serve on a board, on a charitable organisation, etc. And many people go away from this being shit scared, frankly. Can I go away from this being totally reassured that, because there was even the word skill in there, and many times you're a volunteer on the board and you haven't got the skill for that particular thing, but you are there because you want to do the best you can. So can I go away from this being reassured that if I do the best I can, and we have our regular and I know that we actually do nearly all those things that you've been talking about, but I want to know that I'm protected. But otherwise there'll be no volunteers.
Yeah.
There really will not.
Yes.
So if I do my best and don't steal money and don't run over someone, I'm protected.
Yeah. I can't give a guarantee. Obviously, I can't give a guarantee. but I think it's very important that if you take on a role as a director of any company.
See, we don't even use that word. So we're board members, but we're not called directors. So it's the nomenclature.
Yes.
Even that.
Responsible person. So as a charity, you're a responsible person under the ACNC governance standards. And what those governance standards say is that, look, at the end of the day, the expectation is that you will take the job seriously. You read the board papers, you read and you question. The most important thing for any director is to question.
I wrote down, you can't rely on management. I can write that bit down.
Absolutely.
And then I wrote down no such things as leading director.
And doing interesting things. So as a director, sometimes I will say to a management person, show me the proof that you've spent it on this. I want to see the invoice. And this is just at a board meeting. Go away and and it's no notice. It's just a random thing, and it's nothing big. It's just an ordinary expense. Show me the invoice. Show me the receipt. Can I see the actual bank statements? Right. So, you don't get Paul to provide to you, these beautiful financial statements. You actually say, I want to see the bank statement. I want to actually see the real thing, right? How much money is actually in the bank, right? And so it's those simple things, and I call them common sense things.
Yeah.
Yes.
You're just doing common sense things.
Be sure that common sense is still there.
Yes.
And all these new things that are coming, there is common sense and reality, and we are a small community, and
that's right.
We need our volunteers.
And I think the ACNC takes the view that they appreciate that in small charities there are volunteers. The charities wouldn't survive unless there were volunteer directors. And so they take that into account, and they don't take the huge, big stick approach that ASIC takes. they're a little gentler. And it's only when charity, like I act for big charities, multi-million dollar turnover charities, and the expectation there is a lot higher on directors on responsible persons than it is on somebody where the turnover might be a couple of $100,000. So the larger the turnover, the more sort of commercial or corporate that it looks, the more you need to be concerned about ensuring that you're putting in place all of the necessary safeguards to protect you as directors from potential breaches of the standards.
So, to that. So how, with this, again, small organisation, we engage accountants and auditors.
Yeah.
Can we trust the reports?
That's a really good question. So my view is, both as a director and as a lawyer, is that yes, you can, but you've got to test. You can't just rely on what Paul provides to you. Because if you just rely on what he says and you don't question, you've failed in your duty, right? You've got to, and you need to be asking him, what does this mean? I don't understand what this means. Can you just explain to me what a current liability is as opposed to a non-current liability? Right? If you don't know the difference between a current liability and a non-current liability, then you need to be asking the question and you need to get the answer and you need to understand the answer to the question that you've posed. So it may be for smaller organisations, it may be that instead of having quarterly meetings, that you have shorter monthly meetings. So that, and you just say, February and April and whatever, we're going to just focus on financial. March and May, we're just going to focus on strategy. June and September, we're going to focus on operations. And so you're understanding how it works. So there's all sorts of things that you can employ in terms of assisting you in dealing with the work of a director. And I think it should, you've said you're a volunteer, but I think you need to view it as the work of a director, because that's what it is. You're working as a director. You can't just put it to one side. You really have to go through and understand and appreciate and look at trends. As Paul was saying, you look at trends, you see what is happening, and if things are going up like this, and you're employing your revenue and you're employing particular strategies, why would you change the strategy? And Paul's example of the 75-year-old company changing its strategies, and all of a sudden things go down. Any online?
It's kind of relevant to that because given the increasing cybersecurity, AI, privacy, all of those things that are coming out, what director responsibility do you think boards are currently underestimating this?
I personally think we're underestimating cybersecurity risks. They're the greatest risk. I think depending on the organisation, there'll be very particular risks associated with each organisation. So an organisation involved in dealing with children, for example, has a significantly higher risk. Just simple things like making sure there's windows on doors. you know, that sounds like a silly thing, but if you're dealing with children, that's what you need to have these days. There's a whole host of different things. You need to examine what it is that your organisation deals with and work out what are the risks. Do, as Paul was suggesting, that risk appetite, go through that process, understand what the board's risk appetite is to particular risks. And I've even suggested to boards that they actually have that on their agenda, just a little paragraph up the top. This is risk appetite for this, low. Risk appetite for this, high. So that they're always being reminded. So, can you just press the next button?
Yep.
Just some key takeaways. I think for everyone, firstly, know your duties. We've talked about the sections. Remember that the standard is objective. So that means that it's what a reasonable person looking in, not you, the reasonable person looking in. And the reasonable person is not someone who's, and this is important to say, the reasonable person is not the person who's been in the job for a week. It's the reasonable person who's been in the job as a director for 20 years with all of that knowledge and skill. So that's another thing just to be very, very focused on. Stay informed. If you hear of something happening, you don't know what it's about, phone advisors, look at your board, say, with a not-for-profit, you'd say, okay, do we have any lawyers or retired lawyers or law students, somebody who has knowledge? Do we have a financial person? Stay informed, document everything, have a book, you go to meetings, I said this, said that, it's not necessarily everything that's in the minutes is going to be reflective of what happened at that board meeting. Seek advice early. So if you see that something's not quite right, or you feel it's not quite right, seek advice early. I can't stress that enough. There's some incredible tales that could be told about what happens in companies just in our neck of the woods, let alone in Sydney or Melbourne. Here, all sorts of things can happen, and they do happen, and they could have been far less dramatic had people sought advice early. Finally, embrace the regional strengths. Use the community that's around you. Use the local knowledge. Ensure that you stay in touch with your customers. Take advantage of the governance that exists, which is unique to boards within our communities.